Hello, everyone. Trader Razor here from Conquer Wall Street. It is January the 3rd, and I'm thrilled to share my first of the year long term technical analysis of the major stock market indexes, stock sectors, Bitcoin, Ethereum, and a few of our trading systems built for busy investors that work during normal trading hours but want to profit from easy to follow end of day trading strategies. Now, I know that some of you might be seasoned investors while others are just starting out. And that's perfectly okay. If you have any questions at all, don't hesitate to reach out to our support team at conquerwallstreet.com. We're here to help you navigate this wild world of investing. Remember, this analysis is just one more tool in our toolkits to help you gain insights into the markets. And the weekend of January 3rd didn't include a Santa rally. I know a lot of traders and investors take short term trades during this time period because the volume just drops off and it's almost guaranteed profits to know that the markets just kind of inch up slowly on low volume. But that really wasn't the case as we look closer at the charts. There wasn't really a whole lot of positive trading action to end the year in stocks. So we'll just strike up 2024 as the year with no Santa rally. Some might argue that that is a bearish sign for the markets, and I would have to agree with them. I'm seeing some troubling things in some of the charts that I follow that make me cautious going into 2025. But we see that the year ended with impressive gains for 2024. The S&P 500 was up 23% on the year, and I think that exceeded the expectations for most everyone. That was quite an impressive run for equities, considering the valuations and the average price to earnings multiple for stocks. Uh, I didn't think they would run quite that far myself, but for those of you that stayed long, congratulations. And those of you who did stay long, you probably profited from our Trendmaster Pro trading system, which went long on February 24th of 2023. And you've been long for almost 2 years now. And we locked in profits along the way. We locked in profits at $435 a share when we hit our 10% profit target. We locked in more profits at the 15% profit target. And we also locked in at a third profit target of 25%. And we've just been pocketing cash while we've been taking some money off the table along the way. So, congratulations to all of you who got long in this trading system 2 years ago. Even if we get a steep market correction at this level, we have locked in profits at 3 different profit points along the way. So, you've greatly reduced your risks by using this trading strategy. And the strategy's performed really well. This is a back-tested look at the Trendmaster Pro trading system for the S&P 500 or the SPY ETF going back 10 years. And you see it closed 15 trades over that time. 86% of them were profitable. It produced an astronomical profit factor of 7.658, had a max drawdown of 12%, and had an average winning trade of 13.37% over that period of time. So, congratulations again. That's excellent. We've taken, like I said, a lot of risk off the table for you long term investors just by taking profit targets at strategic points. But that being said, as well as the S&P 500 and the stock market performed in 2024, it is nothing in comparison to what we see happen with digital currencies. And here I have a 1-year heat map for some of the biggest market cap cryptocurrencies or digital currencies on the market. And we see some really impressive gains that just kind of put the S&P 500 to shame for 2024. Bitcoin was up 131% for the year. XRP was up even better. It was up 296%, and Ethereum produced a 56% gain, doubling that of the S&P 500. That being said, these digital assets don't come without their share of volatility, as we can see massive corrections that can just kind of melt you with the speed at which these currencies can correct at different times. But either way, if you have a long-term perspective on these digital currencies, you see there's significant upside momentum in some of these assets if you can time them at just the right time. When we look at 2025, though, we want to see what do the experts think this year is going to look like if 2024 produced such impressive gains in equities. Well, most analysts and experts are bullish for 2025. As a matter of fact, it's really hard to find anyone who has a bearish perspective on equities going into this year. And we can just look at some of the calls that we have from places like Bank of America. They have a target of 6,666 for the S&P 500 by year end. BMO Capital has a 6,700 price target. And Deutsche Bank is extremely bullish with a target of 7,000 for the S&P 500. And we can look even further and see Evercore is 6,600, Goldman Sachs 6,500, and Morgan Stanley is also 6,500. That every single one of these major firms believe that there is greater upside in 2025. We also see Yardeni has a $7,000 price target, and UBS has a $6,600 price target. And when we look at Bitcoin, we see even loftier price targets if we believe Tim Draper, who's predicting that by year end, that Bitcoin could hit $250,000. That would be a 150% gain for the year. That would exceed even the wildest analyst predictions for the S&P 500. Will that happen? I don't know. Bitcoin has already had quite a significant run for 2024, and I think that you would need something fundamentally to happen, either with currencies or elsewhere, that would cause that type of a move for the year. What that would be at this point in time, I can't foresee that, but I am optimistic on a long-term perspective for a lot of digital currencies, Bitcoin and Ethereum included. So the other question that people hit me with all the time is, will we have a recession for 2025? Well, if you believe the experts in this article, they give a less than 15% chance of seeing a recession in 2025. Now, my opinion is a little bit different. I think of most major recessions or corrections in the market usually come from unforeseen geopolitical risks or other things that weren't foreseen by analysts and market experts. One of those things that concerns me a great deal is the fact that the Federal Reserve isn't going to be cutting interest rates what the market predicted going into the future. If anything would change to that probability, if they would even maybe flip the switch and become even more hawkish and possibly increased interest rates, I think we could have a recessionary effect that would produce. As it looks right now, for January of this year, there is pretty much a 0% probability that the Federal Reserve will make an interest rate cut. That looks like they're going to keep things unchanged. At least the probabilities now are at 89% that they will not touch the interest rate at all in the month of January. And like I said, if they would become more hawkish, we could see a more severe correction in equities. And that would be something that I believe would be unforeseen moving forward. The other thing that concerns me is the large move we saw in the Magnificent Seven stocks. Especially at the end of the year, they've been producing better than the overall market, which we'll see a little bit later in this video. Last week, I speculated that might have been a Santa rally, or not a Santa rally, but fund managers doing a little bit of window dressing with their portfolios by putting in some of the top performing equities into their portfolios to demonstrate to their shareholders that they were in some of the best performing asset classes. And we won't know if that was the case or not until we move a little bit further into January of this year and see if money starts rotating out of those assets and into other asset classes. At this time, it doesn't look like that's the case. And we see a great deal of outperformance in those Magnificent Seven stocks. Here we have the Roundhill Magnificent Seven ETF, which invests in these seven equities: Google, Microsoft, Amazon, Netflix, Apple, the Magnificent Seven. And you see the solid line is the S&P 500, and you see how well those equities have outperformed the overall market. Now, keep in mind, we just talked about the S&P 500 being up 23% for the year. And when we look at how much these other equities have been up, it's been just blowing the doors off of the overall market. Amazon, 47%, Meta, 70% almost, Nvidia, 176%. Will it continue? Well, that remains to be seen, but it's something worth keeping an eye on. The other thing that keeps me awake at night for a possible correction is the price to earnings multiple for the S&P 500, or the average uh, stock within the S&P 500, is currently around 31. That is well above the historical average of 20, and it seems like equities are priced for perfection. If anything would go wrong for analysts and experts forward-looking growth for the economy and for equities, I think we could see a massive correction in stocks. So let's take a closer look at the equities and just see what the picture technically looks like for stocks moving forward. And we'll start off with the monthly chart of the S&P 500. One thing that concerns me a great deal is the extension that we see on the monthly chart. On this chart, you'll see the 200-month moving average and the 50-month moving average. I've said it week after week, but in a healthy market and a healthy uptrend, we see the index come back and touch this 50-month moving average, bounce off of it, and move up again. We saw that happen back in 2023, but we haven't seen it happen really in the last 2 years. And look how far extended the S&P 500 is from its 50-month moving average. If something would go wrong with price to earning multiples up around 31, what type of correction would we expect to see? Well, we could possibly see it come back here and touch the breakout at $479 per share, or we could see a healthy pullback down to this 50-month moving average, which is significantly below the price of $591 per share. And what's interesting, if you would see a correction down to these levels, the S&P 500 would still be in a long-term bullish uptrend, at least on a monthly perspective. Here we see a chart of the QQQs, the NASDAQ Trust, and we see the same thing, except we have a really nice steep uptrend line on the monthly chart. We could see a pullback and touch to this trend line, which would be the most bullish scenario from a long-term perspective for the Qs. Hopefully, we'd see a pullback to that level and a bounce off of it. If it would break down from there, we could see a more severe correction down to $408 per share. But take a look at this trend line I drew going all the way back to 2016. You could essentially break through 408, break through the 50-month moving average, and tag this trend line around $275 a share, and the Qs would still be in a long-term uptrend on a monthly chart if you go all the way back to 2016. Now, that's quite a bit of a correction to have to swallow depending on where you've entered into equities. So keep an eye on that, but know that things are priced to perfection. And if something goes wrong, we could see a severe pullback in the markets. And that's something that keeps me awake at night and watching my money and my positions closely. Here we see the Dow Jones Industrial Average. Again, same story as the SPY and the Qs. Still, we have a nice little channel going on. The Dow is already touching the lower band of that channel, and it's worth watching to see if it breaks through that lower trend line. It could bode for a deeper correction. One of the things we'll discuss later in this video is that we're seeing a move to those Magnificent Seven stocks, those large mega cap growth stocks, and the Dow Jones Industrial Average, the blue chip index, has been lagging a little bit moving forward. Here we see the weekly chart of the SPY, and narrowing a little bit more, we can see a little bit of a rising wedge starting to form. We could potentially test this lower trend line around 580, 70 per share and get a bounce from there. That would be healthy in the short term. Here we have the QQQs, and we have a zoomed in view of that trend line, that lower trend line. We can see that kind of coincides closely with the 50-week moving average, which could act as an area of support. Dow Jones Industrial Average is zoomed in view of that channel. And as I said before, we're testing the lower portion of that channel. Currently, we'd like to see a bounce off of that level, uh, leading us to believe that this trend, this uptrend, will continue in the Dow Jones Industrial Average. A breakthrough of this could lead to a sideways movement or possibly a correction. Weekly chart of the S&P 500. One thing we've been watching for quite some time is the divergence on the weekly chart between the RSI index and the MACD index and the SPY itself. And you see that's divergence been going on for a few weeks now. I've been talking about it for a few weeks now, and we're starting to see a little bit of that play out. For me to not be cautious because of this divergence in the S&P 500, I would have to see the RSI break above this trend line and put in a higher high, but we haven't seen that yet. It could bode for a more significant correction in this index. QQQ has the same thing playing out. We have that divergence in the RSI. We have that divergence in the MACD. And on the weekly chart, we can also see a bit of a wedge forming. We're watching that wedge to see if it breaks down. That would give us an inclination that this divergence is going to play out to a greater degree. Another thing I'm watching is the advanced decline lines. Here we see a chart of the S&P 500 on the top, and we're comparing that to the cumulative advanced decline line, and the advanced declining issues is the middle indicator, and the lower indicator is the ratio of the advancing and declining volume in the stock market. Now, when we see the pullback that happened here in December from the all-time highs, we noticed that at this point in December, we had extremely oversold levels in advancing declining volume and also advancing declining issues. When I see both of those coincide, it tells me there's a strong possibility of a bounce and an inverse reaction. It doesn't mean that the downtrend is over. I would like to see higher highs and higher lows start to establish themselves to tell me that we're going to continue to take out this previous all-time high. But we did see an extreme reaction to these extreme levels in that we got a bounce. So after December 16th, when we had these extreme levels in the advancing declining issues and volume, we immediately got a bounce up to around the 600 level, but we didn't put in a new high. So this needs to be watched and monitored. It would have been encouraging to see that these extreme levels took us back up to the highs and took out the highs. We didn't get that. Also, I'm watching the cumulative advanced decline line to see if we detect any divergences going into the market moving forward. When we were basing around here at the highs, we did notice a little bit of a slight divergence in the cumulative AD line. That did play out into the correction. We need to see this become a little bit more constructive to the upside. Looking at the S&P 500 versus the percentage of stocks trading above their moving average within that index, we first look at the lower indicator. This is the percent of stocks within the S&P 500 trading above their 200-day moving average. And we saw a divergence going into December that gave us caution, and then that divergence played out. Here we see it on the 50-day moving average, or the percent of stocks trading within the index above their 50-day moving average. And at that time, a few weeks ago, I pointed out we see lower lows and higher lows coming in here, and it was kind of consolidating. So we had a divergence on the upper end, and we had a higher lows coming in the lower end. I said, whichever direction this indicator breaks out, whether it's to the upside or the downside, is going to indicate the next direction for the market. Well, look what happened. We had this breakout to the downside while the SPY was hitting new highs. And now we have a correction. So we currently have this index at oversold levels. And a lot of times, if we get a break above this lower trend line, this 30 level in this indicator, we might see a move to the upside because we have this shows that a lot of stocks are trading below their 50-day moving average. We need to see them starting to retake their 50-day moving average to get a little bit more bullish moving forward. When we look at the QQQs and the NASDAQ, same thing. We see the divergence that happened before the correction in this indicator. There were fewer and fewer stocks in the NASDAQ trading above their 200-day moving average. Now, the Qs itself is trading above its 200-day moving average, and the 50-day is above the 200-day, which is bullish from a longer-term perspective, but we will keep a close eye on this. We see the same consolidation when we zoom in to stocks trading above their 50-day moving average. That broke down to the downside, and it broke down before the prices in the index broke down. We see the Qs started to hit higher and higher highs while this was breaking down, and we knew that a correction was imminent. Moving forward, for those of you that follow the max pain theory, the max pain for the upcoming monthly expiration on the S&P 500 is currently sitting around $582 per share. And we see that the index tagged that level and bounced off of it. Whether or not those holders of those equities, or I'm sorry, of those contracts on the S&P 500 rolled those over to the next month, I do not know. But we do have the S&P 500 trading below its 50-day moving average and in between that max pain level. And moving forward, if I was looking at the February contract, if I recall, I think the max pain for February monthly expiration was about $591 per share. And that's kind of where we're trading at right now. That tells me that market makers are kind of thinking that the market is going to move sideways moving forward in a range, that we're not going to really see any upside or much downside from here, but we're just going to kind of be range bound on the SPY, at least going into February. Now we're going to take a look at the stock sector analysis for the major stock sectors in the stock market. And here we have our sector heat map, and we have a sea of red. A lot of the top performing sectors had bad weeks, but we did see a laggard. Energy has been an underperformer all of 2024. I have spoken at great length about how there needs to be a lot of technical improvement in the energy sector for me to get bullish on this sector. But I did find a lot of the valuations in this sector to be attractive. But energy, the value name, put in a good week. It was up 2.5%, while everything else was pretty much in a sea of red and floating in negative territory. First, let's start off with the ratio charts where we compare the performance of certain sectors against the overall market. First up, I have a chart showing the equal weighted S&P 500 versus the S&P 500. As you already know from previous videos, the S&P 500 has a majority of its weighting into a lot of mega cap names, a lot of those being the Microsofts, Apples, Googles, Metas of the world. And the RSP is the same exchange traded fund, but it equally weights all of its holdings. And we can see that has underperformed, which is why I've been kind of cautious, is that we have too few stocks holding the markets up. It's the same big mega cap names that are pushing equities higher. And it is not a move where there's a lot of participation from a lot of different equities moving the market forward. And we can see this here when we look at the Magnificent Seven versus the S&P 500. And I showed you earlier the overall performance chart where I had a line chart comparing the S&P 500 to the MAGS ETF. And here we have a ratio chart showing the same thing. And we see that money has been outperforming in the Magnificent Seven holdings versus the S&P 500. I would like to see the S&P 500 and other names start to outproduce the Magnificent Seven to really have me feeling good about where the market is going. Here we also see the growth stocks are outperforming the value stocks, which is quite interesting. A lot of those growth stocks, though, within the Vanguard Growth Exchange Traded Fund, VUG, are those Magnificent Seven holdings. And we see that those have been outperforming the S&P 500. And here's a chart of the mega cap names versus the SPY. And we see that same outperformance there, that we see a narrowing of which sectors money is rotating into at this time. And we talked about Bitcoin being an outperformer at the beginning of this video. And here we can see a ratio chart of Bitcoin versus the S&P 500. And coming into November, we had that big move in Bitcoin. And you see the drastic outperformance of that digital currency versus the overall stock market. On a sector by sector basis, we'll start off with the communications sector. This has been one of the top performers for 2024 and is one of the best looking chart sectors that we're going to go over in this video. You can see that the XLC communication sector is still holding above its 50-day moving average, while the S&P 500 is trading beneath it. This is a bullish sign. I'd like to see this continue to hold above its 50-day moving average. We also have a couple VWAP lines down here from the lows of August of 2024 and September of 2024, and the index is currently trading above both of those. If we get a sharper correction, I would imagine that we'd get some support at this gap we have back here at $94 per share. And if that would give out, the next stop will be in the $90 to $91 per share range for this sector. But this will still remain in a long-term uptrend, I believe. Financial sector is a little bit more concerning. Like the S&P 500, the financial sector has given up its 50-day moving average. It is currently holding above its VWAP from August of 2024. And we are currently trading in here at gap support between $47 and $48 per share. We need to see it come back and regain this trend line that it lost going from August through December. It broke through that trend line of the 50-day moving average. We need to see it regain that and get upward momentum. Industrial sector. This is another stock that was performing well for most of 2024, but broke down, took out its 50-day moving average, and is significantly underperforming the S&P 500 right now. You see the series of lower highs that are put in. It is really getting close to testing its 200-day moving average. We need to see that hold and some constructive action starting to form in this sector. Material sector, another ugly sector. This is one of the sectors that was performing okay. We put a double top in 2024 between October and November, and it's just been a series of lower lows and lower highs. Since then, we have a cross of the 50-day below the 200-day moving average, which is extremely bearish. And this system is just washing out. We did get a buy signal in one of our, I believe it was our Trend Sync Pro trading system, but it hit its stop loss at 10%, and we are currently in cash in this position. Utility sector, this is an interest rate sensitive sector. You see it trading below its 50-day moving average. As interest rates remain stagnant and at elevated levels, this does not bode well for utilities, which likes lower interest rates. A lot of money will rotate into that for those folks that are looking for income-based investments. But when CDs are high and trading at higher interest rates, there is no risk putting your money in a CD because they are FDIC insured, and utilities will take a little bit of risk to your holdings because prices fluctuate. So we're seeing this have an adjustment based off of the news that the Fed will not be cutting rates as much as everyone expected moving into 2025. And you see the series of lower highs that it's been putting in. It is currently retesting that volume weighted average price that goes all the way back to July. It needs to get above that and get above the 50-day moving average to be in a more constructive position. Technology sector. Technology has been a laggard for a season, but it looks like it is a top performer currently. It is back above its 50-day moving average, and I think this is on the wings of a lot of the Magnificent Seven mega cap technology holdings. I would like to see it put in a new all-time high and take out the 240 range. We will have to monitor this a little bit more closely, but other than that, technology looks to be one of the better performing sectors moving forward. Consumer staples, underperformer. Again, we are below the 50-day moving average. We are below this VWAP that goes back into April of 2024, and we are trading below our 200-day moving average. I have this as an avoid for myself. The chart does not look constructive or healthy to me, and I would avoid this section personally, and I would be looking to put my money into charts in sectors that look more bullish. Consumer discretionary. This has also been a top performing sector. We have the trend line going all the way back to August. That has not broken down. It has not traded below its 50-day moving average throughout this correction. And we are currently testing support at around the 220 level, which coincides with the 50-day moving average. It looks like we got a bullish move off of that $50 price level, and we have some volume with that move. It's worth keeping an eye on whether or not this picks up steam and retests the all-time high around 240. I've been saying for weeks that I love this sector. This sector has been producing well, and I've been looking for an opportunity to add capital to this sector in the stock market. Well, I might be getting that opportunity as it is touching the 50-day moving average. I will keep an eye on this sector personally and monitor it more closely. Real estate, again, underperformer. This is an interest rate sensitive sector, currently trading below its 200-day moving average. The 50-day moving average is starting to curl and roll over. And this is all coming out of this double top we see from between September and December. It put in a double top, and it's just getting kind of ugly from here. I have this as an avoid also. Energy sector, we did get a good bullish reaction coming out of the election on the promise that domestic drilling would be bullish for a lot of the holdings in this index. That never panned out. We are getting a good reaction this week, but I think that's off of the correction. A lot of money is going into some of the value names. The energy sector does not look constructive to me at this level. I would really like to see a series of higher highs and higher lows put in, and eventually taking out this $98 price level for me to be more constructive on this sector. And gold. Gold, I'm a fan of gold. We are currently bouncing around the 50-day moving average, but above, we had this little basing action here between April and August. I've been talking about that for some time. Gold likes to make big moves and base for a while, and then break out of that basing pattern into an uptrend. So we see this move from 2024 where it based and it built up volume. You can see it on the volume profile, and it built out an area of support, and then it broke out. Well, now we're seeing the same thing starting to happen. It broke down from that trend line, but we're basing right here in this $240 price level, and we're building up volume on the volume profile. We're building up an area of support. Will this break to the upside? I believe it will at some point. There are some geopolitical things that could have that happen maybe sooner rather than later. I know there's war with Ukraine, there's things going on with Israel. And if we get a correction in the market, a lot of times a flight to safety will move into gold. And with elevated valuations in the market, there is always that possibility. Here I have a little bit more of a zoomed out view, a weekly chart of gold, and we see those basing patterns again. You can see here from 2013 to 2019, we had this big long basing pattern, multi-year basing pattern in gold, but then it breaks out. And then we see the same thing here. We see a multi-year basing pattern for gold, and then it broke out again. On a weekly chart, this might be in the infancy and it might be treading water for a little while. I don't think that's going to be the case, but it is possible that maybe gold will just tread water for a multi-year move. I personally don't think so, but time will tell if I'm right or not. But gold does have a history of big move breakouts and long basing patterns. That being done with the sectors, let's move forward to digital currencies for the week ending January 3rd. And we always start off with the fear and greed index. This has been up at greed levels even throughout this stock market correction. The fear and greed index has been in the greed or extreme greed level. A month ago, we were at extreme greed, price point of 78 on this oscillator or indicator, whatever you want to call it. But now we're kind of in the 74 level. So that we're a little bit less greedy, but it is still elevated. And if you understand how fear and greed works, when everybody's greedy, you should be fearful because that is when sharp corrections happen. So I'm on guard because Bitcoin and a lot of digital assets have made such large moves to the upside. I am on guard for a significant pullback or correction in this asset that will happen fast and quickly if it does happen. But it doesn't mean I'm not a long term bull on digital currencies. I would see it as a buying opportunity because I'm a dollar cost averager into a lot of these positions. And I always follow the flows of assets on CoinShares. They did not update it this week. This is from December 20th. But we saw a lot of money pulling into Bitcoin and Ethereum. It would be interesting to see what the data says following December 20th and after Christmas, if money is still pouring into a lot of these assets. But we saw big moves throughout the year into XRP, Ethereum, and Bitcoin. Here we're taking a look at Bitcoin long-term holder supply. This is the supply. How should I put this? It is the amount of long-term holders of Bitcoin that have held their uh, crypto for greater than 155 days. And a lot of times this can give us an indication of whether or not profit taking. A lot of times, smart money will take money off of the table when it comes to the digital asset. And you see that there were a lot of long-term holders going into the move that Bitcoin had to the upside. But now we see a lot of those holders are starting to take profits. Could this mean that Bitcoin is going to come into a correction moving forward? Possibly. Uh, does it indicate that smart money maybe is taking some profits? Possibly. We'll have to see how this plays out, but historically, this has been a good indicator of what's going to happen in the future. As we look here in January, we saw all this money, um, long-term holders were holding on to their coins, but then money started to come off as Bitcoin was making this move from January to April of 2024 when Bitcoin was moving up. This long-term holders were selling some of their Bitcoin, and then Bitcoin went stagnant throughout that period. But before the big move that we had at the end of the year, those long term holders were increasing their positions. Now we see the exact opposite. The move already happened and money is coming out of long term holders' wallets. We'll have to see how this plays out. Keep an eye of caution in here. We might see a correction in Bitcoin. Here we have the Bitcoin exchange reserves, the amount of Bitcoin held on exchanges. This is a delayed chart. It doesn't have things updated most recently, but up until December, we see that the amount of Bitcoin on exchanges has been getting less and less as Bitcoin itself has been going up in price. This is a bullish case for Bitcoin and for prices to sustain themselves. If we start to see large amounts of Bitcoin coming onto exchanges, it could mean that we're going to see a more significant pullback because people usually put their money on exchanges to unload their positions. Next up, we have spot Bitcoin ETF flows. This is really unremarkable going in through December and the holidays. We don't really see anything really significant to comment on in the light volume that we get around the holidays. Here we see spot Bitcoin inflows and outflows from exchanges. And we are starting to see a little bit of Bitcoin flow onto exchanges. And that's a little bit what I was talking about with the holders chart. If we start to see money coming onto the exchanges, it would make me feel a little bit more cautious that we might get a correction. Now, this isn't a lot of Bitcoin. It doesn't look like a whole lot in comparison to some of the other moves we've seen throughout the charts, but it is worth keeping an eye on. Here we have the weekly chart of Bitcoin paired with the US dollar. And we see what a move we've really had. Those previous all-time high was around 74,000. And then we put an all-time high around $108,000. And on the weekly, we'll see this on the daily chart in just a moment. You can see different levels that we could see a pullback to in the event of a correction. The first would be this trend line, which would be somewhere around 80,000 per share. Also, the previous high and all this traffic we have in the $73,000 to $65,000 price point on Bitcoin. And then longer term, if we get a sharper correction, we do have this trend line on the weekly chart that goes all the way from 2023. That would line up with about 50 to 55,000 per share. Here we see the daily chart. The weekly chart of Bitcoin paired with the US dollar. We see a nice cup and handle formation where we broke out to a new all-time high. But Supporting the fact that we could get a correction in Bitcoin is the fact that we have this divergence on the weekly RSI. I've been talking about this for a few weeks now. Sometimes these take a little bit of time to play out. Uh, to make me change my mind on this, I'd like to see the RSI break above this trend line and put in a higher high. Here's a daily chart of Bitcoin. We see some of those trend lines that I showed you on the weekly chart, but support would be significant down around the 73.8 to $65,000 price point. We have the trend lines, previous all-time highs, and the 200-day moving average all kind of coinciding in that area. That being said, the volume has been light through the holidays, and we're seeing this area around 93,000 where volume picks up on the volume profile holding nicely. And we're kind of getting even a little bit of a bounce coming into the new year off of this price point where we've regained the 50-day moving average. Moving on to Ethereum, spot Ethereum exchange traded fund flows is also unremarkable in these shortened holiday weeks that we've had ending in December, heading into January. But I do show these charts every week. Ethereum spot inflows and outflows onto exchanges really are unremarkable. We do have this large day here of inflows. Maybe there was a whale that was adding some Ethereum to the exchanges, but you only really see one day here. This is also very unremarkable to me. And here we have the weekly chart of Ethereum. Ethereum's really been in a sloppy chart pattern, hitting these big moves anywhere from up to around $5,000 per token, down to around $1,000, $1,500 per token, going back to 2021. Just big moves to the upside and downside, but it is starting to consolidate. As I've pointed out in previous videos, we're starting to see this little consolidation pattern. We're looking for a breakout to the upside on volume. We do see on the weekly chart since October, volume has been picking up in Ethereum paired with the US dollar. But we really need to, for constructive purposes, we need to see this break out above the $4,100 level. Otherwise, this is just a double top. And we need to come back to this all-time high around 48.67 to really see a significant move in Ethereum, in my personal opinion. Here we have the daily chart. You can see there isn't a whole lot going on here. Just these big waving moves between that $4,000 to $2,500 price range. We do have the 50-day moving average trading above the 200-day moving average, which is constructive, but we don't really see a continuous pattern of higher highs and higher lows that we can really build upon. That's all I have for you in this video, folks. I thank you for taking the time to watch. As always, have a happy new year. Stay sharp and prosper. Trader Razor out.